Welcome back to Alpha Insights. I'm Allison, and today we're unpacking a recent short seller attack and what it really means for investors. Joining me is Josh, our calm market historian who loves to pull apart narratives and get to the facts. Josh, great to have you.
Thanks, Allison. Happy to be here. And the real question here is how much of the headline is substance and how much is theater?
Right. Quick note for listeners. If something we say sparks a question, you can ask us at stockalpha.ai. All right, Josh. Wolfpack Research put out a short report on Poet Technologies that got a lot of attention. For folks who didn't read the report, what's the essence of the claim?
Broadly, the short seller highlighted a narrow tax classification issue, that Poet meets the rules of a passive foreign investment company, or PFIC, for its most recent fiscal year. Wolfpack then built a larger narrative around that, implying hidden problems, management deception, and that the company is effectively a cash shell. That's the short version.
So PFIC, that sounds scary to a lot of listeners. Break that down for us, in plain English.
Sure. PFIC is an IRS label that applies when a foreign company's income or assets meet certain passive thresholds. For U.S. shareholders, it can create awkward tax rules designed to prevent people from sheltering income abroad. It is technical and it matters for tax paperwork, but it is not inherently a signal of fraud or a broken business.
And in this case, Poet acknowledged the classification, right?
Yes, management confirmed the PFIC status for the recent year and proactively provided QEF election materials before the mid-April filing deadline. The practical impact for U.S. holders in that year is essentially zero because the company reported a net loss, so there is no taxable income to include under the QEF rules.
Interesting. So the tax issue exists on paper, but the immediate financial pain for shareholders was minimal.
Exactly. And they didn't stop there. The board has approved a plan to re-domicile to the United States, which, if approved by shareholders, would eliminate PFIC exposure going forward. Management also indicated they expect not to qualify as a PFIC in the next fiscal year, based on projected revenue and asset deployment.
So why did the stock react so sharply when the report dropped?
Short sellers know how to time narratives. A high multiple, pre-commercial company with a big cash balance is an emotional target. The report turned a technical tax rule into a fear story. Retail investors new to international tax law hear words like foreign and passive, and panic can follow, which can produce a swift price move even when fundamentals are unchanged.
Right.
And to add to that, Wolfpack's model is to find a real vulnerability, even a narrow one, and then amplify it into a broad indictment. That can be profitable if the narrative causes short-term selling before the rebuttal cycle plays out.
I want to talk about the cash number they focused on. The report called Poet a cash shell because it has a big cash balance. What's your take?
Calling it a cash shell misses why the cash exists. Poet is developing an optical interposer platform. That's capital-intensive hardware, co-packaged optics, transceivers, and terabit-class systems. They have about $430 million on the balance sheet to fund product development, demonstrations, and customer evaluations. For deep tech, that's often a feature, not a flaw.
And they actually showed working hardware this year, right?
Yes, at the industry conference earlier this year, they demonstrated 3 live platforms: Blazar for co-packaged optics, Starlight for transceivers using the interposer, and Teralight for terabit applications. Those are functioning systems being evaluated by hyperscalers and systems integrators. So these are not just slides.
Which brings us to the core question. Does the technology have a real market?
This is the right question. The underlying thesis is that AI infrastructure is becoming bandwidth bound, and electrical interconnects are reaching limits. Poet's approach is to integrate 3-5 photonics with silicon CMOS at wafer scale, potentially lowering cost and improving yield versus older approaches. The companies evaluating them are the same ones spending huge sums on data center networking. So, analysts note, if design wins accelerate, the PFIC story becomes irrelevant.
Yeah, that's a good point.
Exactly. We should also be clear. Wolfpack did identify real risk factors: pre-commercial revenue, concentrated technology risk, and that PFIC classification. Those are legitimate inputs into any investor's risk assessment. but the short report's leap to intentional deception doesn't line up with the timeline of disclosures and the company's proactive actions.
Short reactions. Interesting. Right.
And to wrap up, the things that matter to investors now are design win velocity, the pipeline coming out of that industry conference, customer evaluation timelines, and whether the integration advantages hold up under competitive scrutiny. Those are the variables that will determine commercial success.
Great. Josh, before we go, hit us with 2 or 3 quick takeaways.
1. The PFIC label was a technical tax issue, already acknowledged and mitigated for the recent year, with a planned structural fix in progress. 2. The large cash balance is consistent with the capital needs of hardware-scale commercialization. It funds product demonstrations and customer trials. 3. For evaluating POET, focus on technology validation and customer traction, not the short seller narrative.
Perfect. And just to remind listeners, if you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Josh, thanks for walking us through that.
Thanks, Allison. Honestly, I was a bit surprised by some of the panic, but conversations like this help separate noise from the things that actually matter.